Great. So good morning. I am Richard Seeline, the managing director or executive director of Future Proofing America and the managing partner of Roar Partners. We had an opportunity. Some of you have participated in the past. Others who will be listening in have heard some of this. A lot of this will be new. But one of our efforts that we have had as a think tank, meaning Future Proofing America, and a do tank called Roar Partners, has been to tap into really smart individuals within their sectors who get some of the cross-cutting challenges of making a pivot in the nation's risk exposure. And we described this, Erin, as you and I discussed previously, we describe our focus of why this, why now, in one way that kind of keeps us very focused is just this simple snapshot of 1 week's worth of different articles and announcements and data that keep on coming out across this country, whether it's the wildfires over in California, which are still not raging in the wildfire, but raging in the challenge to restart and build 20,000 homes and 400 businesses, which, by the way, Erin, before the wildfire, there was already a deficit of 40,000 homes in LA County, right? And then you've got, the cleanup that's still underway in Asheville, North Carolina. But the fact of the matter is, in any given day in this country, there's some form of a disaster, which these are no longer giving folks enough time to prepare. But more importantly, one stacked on the other is beginning to change, or not beginning, has changed the financial, economic, fiscal with an F, and societal impacts for this country. And as a result of that, we started looking at all of these overlapping and integrated, challenge sets. And you all can read faster than I can, but for today, our focus, given the opportunity to have met and worked with Erin and Scott at Texas Mortgage Bankers, who she'll describe in a little bit, focusing on this issue of mortgage repricing from defaults, but more importantly, what can we do to begin to mitigate defaults is critical for us. But it aligns with all of these other circumstances. Erin, somebody referred to me, and I now accept the title of being called the Vin Diesel of Doom.
Yeah.
Okay.
I think it's great.
Yeah, because one, because I've got the hairline for it, but two, I think it's always very important for us to start every conversation with facts. And some of these are great. Some of these are terrible. I'm going to start with the ones that are terrible. There's nothing that I'm going to show that has a great downward curve, meaning that these continued storms and events, the impacts that again they're having on insurance and mortgages and public treasuries and all are just not going in the right direction. So you see, and you all will get a chance to take a look at this in a little bit more detail on your own. But we started digging even deeper, Erin, and that was this issue around the insurance loss and insurance gap. You can't have close to $5 trillion worth of losses. And David Marstead, who has now joined our board, coming from his long-term state insurance role, senior role at FEMA, both in the public and private sector, can detail better than I can. But you just cannot sustain this many losses and have a insurance market continue to perform the way it has been without making a change. And then the other side of the coin for this conversation, Erin, is So we got this insurance gap on one hand, but we're also beginning to recognize asset devaluation because the assets sit in these highly prone disaster areas. One of the common pieces that we think you've got some insights, and we're honored to support and work with you, is the increasing amount of mortgage defaults, especially residential and commercial. And that is really, really troublesome because it creates a unfortunate experience for people who need to retrofit or rebuild but it also creates an economic negative for the tax base in a lot of communities, right?
Yep.
So we then dug even further to try to find out where some of these pieces are aligning at really a level of a person that is a decision maker, and that is we would like the real estate industry, the home builders, the master plan communities to obviously take on more higher valued project development, but they're not going to do it, Erin, right? You told me this, Richard, they're not going to do this if it's just adding a lot of cost and reducing the profit margin without us finding a way to help them
Come
achieve,
here, buddy.
right?
Sander.
Right. The second part is that, we elected officials are just overwhelmed from having to go back to the taxpayer all the time, right?
Yep.
And then it all leads to this issue that these are places, and they're not all urban and high net worth areas. It's all across the country where you start seeing the economic spiral, right? So, as an example, in our own backyard, Erin, just for us who are in Texas, but this is universal across all 50 states and territories, it's just this constant amount of more disasters, one on top of each other. And to this point that just kind of began to really jump off of the data is you can have a presidential declaration, but not every disaster reaches or will reach that scale of a federal declaration or whatever it is in the future, Erin. And therefore, a lot of states and communities are left to their own to find ways to solve the financial economic issue without any federal funding coming to them. And that may be a different model going forward. So, Erin, with that kind of setup, I am so pumped that you and I had a chance to meet, that you graciously included me several months ago, and we'll talk about that forum as an underpinning of the paper that you've written. But let me pause for a moment. I've had a chance to kind of give a high level introduction, but why don't you give a little bit more introduction and then kind of set the tone for what you would like us to achieve today?
Absolutely. Well, obviously, I just want to say thank you so much for having me. It's so lovely to meet those of you who I had the opportunity to chat with earlier. This is a space that has become very, very near and dear to my heart. So, currently, I am the Chief Operating Officer of Interlink Mortgage. We're a residential non-bank lender located. We are headquartered in Houston, Texas, but we are licensed in almost 30 states. So we have broad geographic exposure across the United States. We originate loans, we service loans, and so we kind of see start to finish what's happening in communities in terms of affordability, in terms of delinquency, all of that. I am also the president of the Texas Mortgage Bankers Association, and in our conversations as an association over the last few years, we've really been focused on that default delinquency space and what is driving it. Obviously, being in Texas, we've experienced natural disasters firsthand, but as an industry, we have really started to see the impact it's having on communities from a delinquency perspective. And we are just concerned as an association and as just professionals and humans that live in our communities, what is really happening to individuals. Affordability, which is kind of the approach that I take to my paper, is really on consumer affordability. it's being squeezed from so many different angles. You go everywhere from, inflation, which was supposed to be transitory, to student loan default, to just the rising price of everything. And then you have insurance costs. The one thing that everybody says is so stable about the US housing market is we have this 30-year fixed rate mortgage. You have the fixed cost of debt. That's what makes our mortgage market so great. We have a fixed cost of debt, but we really don't, right? For so long, that tax and insurance amount, it could change a little bit here and there every month, and it was negligible. But in the last few years, what we've seen is that tax and insurance component, and a lot of it being driven by insurance, is increasing significantly year over year. So you have consumers that think they have a 30-year fixed rate, but when their insurance costs go up by 20, 30 or percent or more every single year, they get squeezed to the point where they can no longer afford just to make their housing payment, much less all of the other expenses that are coming, right? And so my focus is, what can we do as multiple industries to come together to create communities that are more resilient, so that when these disasters do happen, that we're not having homeowners in a position where their house is destroyed, they're having to come up with massive amounts for deductibles, their insurance costs are having to decrease, so they can be in a more manageable situation. And so that's kind of the high level of where I'm coming at it. And Richard, I know I'm happy to.
But look, I mean, you really set, kind of the baseline that we want to build off of this conversation,
Right.
right? Uh, and, and if folks will mute their computers, that'd be great.
Yeah,
Feedback.
it's hurting your self-esteem, is it? It must be.
If everybody will mute their computers, that'd be great. So Erin, let me play off of a couple of things that you
Sure.
just said, because it really is, to some degree, the proverbial peeling the onion. Okay. I want to get to the core on the mortgage side, right? Um, because you also talked about Interlink and what y'all do, but just to make sure, because some people only know the aspects of the mortgage sector from, I want to buy a house, I got to go get a mortgage, I find somebody to lend me the money, whoever that is, I sign my paperwork, and every month I write somebody a check to live where I'm going to live.
Yep.
And then I sell it. Okay.
Right.
Boom. Really easy. Okay. Except there's a lot of components behind the mortgage sector, that some of which y'all do, but just for the moment, I think it's important for folks to understand, that it's more than just, there are people who form the money and resources to lend. There's people who service it. There's people who package a bunch of mortgages up and resell them. Take a minute, if you would, and just give us a little bit of the 101, because I think the 101 also sets the framework for how many ways these disaster issues touch the entire process.
Yeah.
Is that fair? Will you take a minute to do that?
Yeah, absolutely. I'll do that, and then interrupt me if I am not going in the 101 direction that you want. If I'm only in 1.5 or something. So, right. So you come to your local bank or your local mortgage company, and you say, I'm purchasing this house. I want to get a loan, right? So we have to look at your income, at your assets, at the collateral, make sure it all makes sense and follows the guidelines that are established by Fannie Mae or Freddie Mac or FHA, right? And one of those guidelines that we have to look at is your debt to income ratio. And so, can you afford this payment? And to do that, we look at, how much money do you make? What are your other debts? How much is your mortgage payment going to cost? How much is your taxes and insurance? And we put all of that together and say, do you make enough to afford all of those debts and still have money left over every month without putting you in a bad position, right? So we look at that loan, and I'm saying, okay, as of this moment in time, you qualify based on the Fannie Mae guidelines that we're trying to follow. We close on that loan for you. You move into your house. And typically what happens then is I, as a local lender, am going to take that loan, will package them up with other loans, and will sell those off to investors who then receive basically income every single month from receiving your mortgage payments, right? And I get a price for that loan that allows me to refund my business, keep operations continuing, and allows me to then lend to your neighbor. And the reason investors will pay for these bonds is because they know they expect to get a certain amount of payments back every single month to get their return, right? So they've given me money, they want a return for their investment. However, when you start to have defaults, delinquencies, people not being able to make their payments, then you go into default on those loans. And a couple of people can be responsible for that then. So if these are FHA loans, then then ultimately the servicer who's holding that is on the hook, and they're going to have to then take money out of their pocketbook to pay the payments that the people in default are not paying. So that affects me and my cash flow as the servicer. It could have to come from the federal government, from the FHA MIP fund. That's why they have that, to help account for losses. Or if it's a private label security, then the bondholders could ultimately take the loss, right? And so when you talk about making a loan to a borrower and I say they can afford the payment right now, but then something happens, their insurance goes up significantly, their payment goes up, and now technically they wouldn't qualify for that loan, they go into default. That then impacts down the road lots of other people, depending on what type of loan it is, who the bond investor is, and it ultimately impacts cash flow, other companies' ability to continue to do business. The government, the taxpayers could be on the hook for that. And so it really just kind of depends on where along that process that bond is. But these changes in interest and increase in interest and defaults ultimately impact all of those parties.
So let me play off of that, right? Okay. So there's a workflow, there's a process, right?
Yep.
There's a whole set of, but to some degree, it all has relied on the viability of the borrower. But now what we're realizing, see, and let me see if I'm saying this right, Erin. We're now realizing that the borrower, great as they may be, sit in a location for which there are some adjacent or externalities, big word for somebody like me to use, but there's these adjacent or external circumstances that no matter how great that individual may be financially, or in the case of low to moderate income affordable housing, we now have in a setting that is truly volatile, right?
Yep.
So that's the reason why I think you and others have begun to say we could operate within our own shelter of the mortgage sector. But in reality, these billion-dollar events, one on top of each other, and not isolated to just one location in our portfolio, but like you said, 30 different states, different locations, right?
Mhm.
So, how does this, in your mind, right now, and I'm going to focus on the challenge, the negative, how is this playing out for new homeowners, for affordable housing, for retrofits, for rebuilds? What's your sense of right now, Richard, if I were to take a snapshot, not just in our own backyard of Texas, but these other places, this is how it's really playing out on the ground.
So a couple different ways. And when you're talking about consumers who are going to purchase new homes, right now, a lot of them are looking to purchase a home they think they can afford. Insurance costs have gotten to be so high that they're not able to afford the home that they thought they could, right? So it's affecting people's entrance into the market. But even for those who have who are able to get a payment they can afford right now, the problem is we're not really looking at years 2 through 30, right? We're like, hey, we got you, we're patting ourselves on the back for getting for affordable housing, right? But years 2 through 30, we're not really looking at that. And the people who are most at risk is going to be that, to your point, the low moderate income, your FHA borrower. I just talked to a good friend of mine yesterday, and FHA delinquencies exceeded $1 million in September, or borrowers, 1 million loans for the first time in September, and a lot of it is being driven by this, right? So
Right.
you have an FHA borrower who is getting into a loan at a very high DTI, very low down payment. They already have very little, if anything, in reserves. And now insurance costs increasing in years 2, 3, 4, 5, they're in a position where they couldn't qualify for that loan today if they had to.
Now the issue of historical and current analytics versus real forecasting,
Correct.
right? Because this isn't just a 1 year scenario. Yes, I signed my paperwork, right? But let's move past the individual to the bundling of the investment and the financing of these large portfolios, because that's where I'm learning, Erin, from you and others, where this is really breaking down is the larger investment pools, the larger resources. They're saying, wait a minute, Erin, we love that you want to book a lot of mortgages in this area or refinancing, whichever it may be. But when we start looking at our forecast, this is a high disaster peril area. And we're not sure if we want to support you doing that, or it's okay, but let us tell you how we think the pricing points of that mortgage should now reflect this.
Yes.
Tell me where that's kind of going. Is that already beginning to play out? Because it sure seems like it's on the tip of something.
Yeah, it absolutely is. So I actually last week met with servicing leaders from around the country, and servicing is basically the component of, these are the people that once the loan is originated, they're handling basically the administration of that loan, right?
Right.
And this very topic came up, and they are seeing increased defaults because of natural disasters. And so what they're doing then is they're turning around and saying, for me to continue to purchase these assets from you, Mr. Bank, Mr. Local lender, I am going to charge a higher risk premium because these loans cost significantly more to actually manage. If in my paper, I give the numbers, it's $100 a year to service a performing loan. It's $2,000 a year to service or more to service a loan that's impacted by a natural disaster.
Pause. Let me have you restate that. That's
Okay,
$100 over here and 2,000 over here. This
correct.
kid who graduated with a government English degree from the University of Texas can qualify that algorithm. That is a significant jump, right?
Yes, yes,
And that is one that creates the volatility in the marketplace,
yes.
right?
And hurts affordability further, right? Because if you
Right.
think about it, if they're going to charge a higher risk premium for that loan, then I have to charge a higher interest rate for that loan. And so it just becomes a spiral of,
Yeah.
of affordability.
All right. I'm gonna come back to this, but I want to leverage. You and the Texas mortgage bankers convened several months now, a very, very interesting gathering in Austin that included the, you know, uh, insurance industry, home builders, Cotality from their, real estate research. I mean, some really, really interesting folks.
Yeah.
I appreciate you letting me sit at the big kids table, but it was a really, really interesting gathering that fed some insight into this paper, this white paper you wrote. All right. Take a few minutes and, tell us about that gathering. What were you trying to seek out of that from its initial results, and where do you think it is beginning to go next?
Yeah, so really it started in April with a visit to Washington, D.C. And like I said, this has already been a topic that was near and dear to my heart, something I was focused on. And I was doing advocacy visits. I was visiting, congressmen, senators, and also people within the housing finance industry. And I kept bringing this issue up specifically of affordability as it relates to natural disasters. And the answers I got were a lot of like, yeah, it really stinks, but what are you going to do? Or it's somebody else's problem. So
Right.
there really was what I saw as a void in leadership and a void in voice, right, of this. And it also was super frustrating to me because it was like pointing, it was this Spider-Man meme where everybody was pointing at everybody else, right?
Yep. Yep.
Everyone else is responsible. And I'm just like bratty by nature. And I was like, absolutely not. Like, we are going to get in a room and we're going to talk about this. And so we like you said, brought in, it was about 30 people in the room. There was regulators, people from all over the building trades. It was a really great meeting, and really the whole point of the conversation was not to say you're responsible, you're responsible, you're responsible, but to say we are all responsible, and how is this affecting us, and what are some solutions that we can try to push forward. And that was really it, was what are solutions we can start to talk about? So instead of just being like, yeah, it sucks, but what are you going to do? What are
Right.
some even just incremental ideas that can come up? Because at the end of the day, these are the communities that we live in that we are trying to preserve.
Let me share one or two observations. I want to give a shout out to somebody who is a mutual friend of all of ours, is Congressman French Hill, who's now
Yes.
chairman of the House Financial Services,
Love it.
a long time friend who really gets this and is trying to figure out also how you look at this from a whole of government perspective versus just one agency, one department.
Yep.
The observation I had was that we call it enlightened self-interest. You can't have people leave their self-interest at the door, Erin. It's just not possible. So I think what you really did, in my mind, was to get people to come to the table and fairly and openly express, whether they did it as directly as we would want them to, but you could see the notes and the questions and all, right? Is
Yeah.
there is a common enlightened self-interest.
Yes.
That's what you and I have been talking the most about, trying to find, is what is that touch point for the common enlightened self-interest that everybody can take care of what they need in their own organizations, institutions,
Yes.
whatever it is. But this is not um, a singular organization, singular institution, whatever, right?
Yeah. Correct.
All right. So let me ask then, in the paper, which was a summary to some degree of that forum in all of these conversations, all right, if you said, what do you think were one or two or more takeaways that you felt when people got up and left that forum? Because we'll talk about another one that y'all have coming up. But if you said, C-Line, here's my sense of what I've heard back, what were the one or two takeaways that you think now are beginning to create a thread for action?
So, I mean, I think my biggest takeaway, which was kind of really the central theme of the paper, and, maybe it was my own personal bias towards this already, but it's that the government is not the solution to
Right.
this problem, meaning an increased regulatory framework is going to do nothing but discourage and dissent people, right? And so,
Right.
so any solution that we have to this problem cannot be we're just going to have more regulations here. We're going to put more burden on home builders here. We're going to put more burden here. The solution cannot be a top down, we're forcing you to do this, because what that does is it increases costs of compliance. It basically creates a situation where now these people, other industries, are just, they're spending their efforts fighting against increased regulation and not towards solving the problem,
Right.
right? And
Right.
again, and it goes to when you say, hey, I'm just going to use the home builders as an example. Hey, home builders, you have to do all XYZ by regulation now. Then that's singling them out and almost scapegoating them for the problem when that's not necessarily the case, right? And
Right.
the home builders are there doing what they do and trying to earn money, right? And so I think to me that was my biggest takeaway. And
Right.
then I think just other than that, really what I saw really being a consensus is that every single industry has its own little part to play, right? There's something that we can all
Yes.
give. There's something that we
Right.
can all contribute to
Well,
this.
that's that piece of the enlightened self-interest, right?
Yes.
Of
Yes.
what each, I kind of, somebody said this to me, but way, way back. So this is kind of like the proverbial consultants, tribe is, the knights of the round table. They all came into the room, but they left their swords, shields, and flags outside the room, found out what their common opportunity was, got their assignments, and then picked up their shields, their swords, and the flags when they left, right?
Yeah.
And I think what you all and you represent, and hopefully we're trying to do that and some others, is to really create a quote unquote neutral setting for these common enlightened self-interest to
Yes.
have these conversations.
Yes.
But you and I are also very much alike because you are a member of the Get Stuff Done, network. All right. It's one thing to continue having these conversations. It's another one to start finding resolution. So
Correct.
you and I did not really rehearse this. I want to play off of what you said about home builders. Okay. So there are a number of very large home builders, three or four or five that kind of lead the market. And then you've got a lot of other, smaller, medium-sized home builders. But no matter what, at the end of the day, Erin, it seems to be that, whatever the code is, I will build to the code. But every time you add something to this, it's got to reflect on how do I absorb what potentially are the cost, right?
Correct.
So this first cost hurdle is to me where the mortgage world and the folks that you and I are both mutually interested in seeing convene is if it's retrofitted or constructed at a higher value of resilience. We think this is somewhere between 20 and 35% more expensive, depending on what you do, right? It is a range. But I don't care if it's 5%. That's still eating into the margin cap but that's just the CapEx. We aren't even talking about the OpEx once the thing is delivered that you still have to continue, right? So
Correct.
where do you sense, are we headed in the right direction of rewarding investments, incentivizing, or what do we need to do even more to create these kinds of incentives versus the, and no question the building codes are important, but finding a way that incentivizes this pivot versus people feeling like, well, thank you very much. I just got, penalized for doing something. What's your
Yeah.
sense of where that conversation is?
So I think right now under the current administration, the stage is set for it to go in the right direction, and I mean that in the sense that they are focused on deregulation, on tax incentives, on encouraging private investment. And so just a couple examples of that. One, the FHFA under Bill Pulte this week just released their strategic plan for the coming year, and they're actually soliciting feedback on it. So if you guys are into that, I encourage you to read that, because one of the initiatives that they are talking about through the Federal Home Loan Bank is to actually expand and rehabilitate the existing housing stock, right? And so they're wanting to make investments in new housing stock and make investments in rehabilitating the existing. And so where can we say, okay, great, let's leverage incentives, let's leverage tax incentives, or anything else we can creatively come up with to achieve that goal through the FHFA, right? So things like that, I think is where we're going in the right direction. I also think under Scott Turner, HUD Secretary Scott Turner,
Right.
opportunity zones are something that he has come up with, and I think opportunity zones is a excellent way for us to try to leverage this already existing framework to encourage resiliency building to get the benefits of those opportunity zones. And
Okay,
that's
so
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 those
I'm
right
having a
there.
hard time sitting down because oh my God, you and I really not rehearse this. Okay. I want to play off of two things you just said.
I only
Okay.
said two things, so go for it.
Well, no, but I'm just playing off of two immediate things.
Yeah.
Okay. Um, the 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 lead for the Federal Home Loan Bank Board in Dallas attended our first Transforming Resilient Investment roundtable that we did with the Dallas Houston Federal Reserve. And again, French Hill participated in it. We had folks from Fannie Mae, we had, IBHS, which we'll come back to, the Insurance Institute for Business and Home Safety and all. And they've taken the lead as an exemplar of using some of those Federal Home Loan Bank Board resources to buy into this ability for vouchers to be generated for retrofitting roofs, fortifying roofs.
Yep.
Bingo, right? We need to scale that. The second is, actually, 3 points. Second is, there's a lot of controversy and debate about everything in the world right now, but within the context of the recent tax law, 2026 could open up a huge amount of capital for individuals that are of high net worth that need to deploy their capital in different ways. Bingo, opportunity zones made to be resilience opportunity zones.
Correct.
Okay, your good friend Roz, resilience opportunity zones. You don't know Roz yet, but we'll talk about it. Okay, so there is a huge amount of capital sitting on the sidelines. That doesn't seem to be the issue, right? It's not the capital to do this, right? So, Erin, if you could, wave the proverbial magic wand, all right, in 2016, what can we do? Whether it's a pilot, a demonstration, something that gives people confidence that this can come together the right way. If you were to say, C-Line, boy, if I could just, if everything just kind of all rules, all this craziness, whether we have to seek an exemption or a waiver or whatever, what would that look like? What would you put on a whiteboard?
I mean, to me, I think you need to build the ultimate resilient community, right? So
Right.
where can we identify a location where we can build from scratch? In my mind, I mean, retrofitting is okay, but there's so many variables. Like, I would
Right.
love to completely build from scratch so that you have a whole community that is built to these same standards, and then you have insurance companies that are going to come in because they know their risk pool in this community is far less, where we can demonstrate savings. You can demonstrate, just like we've seen in, I think it's in Alabama, right? Your resale
Right.
prices are so much higher here, right? So there's so many benefits that can be provided from having a resilient community, but I think we need to have a fully functioning resilient community that we can deploy at scale as a working model through the opportunity zones, because then you're getting your tax incentives, you are
Right.
getting the insurance benefits, you are getting the resale benefits to homeowners, and you're also just getting the fact that your community is not going to be completely destroyed in an event.
So there are a couple of examples.
Yep,
One
there
that
are.
one that we've highlighted, I've had an opportunity to talk to Sid Kiston and his team that developed Babcock Ranch. Okay.
Yes.
Now, let me put a little asterisk on it. Babcock Ranch has a certain threshold of affordability. Let me put it this way. It tends to be not a low to moderate income
Yeah.
community. But let's just use the context of Sid, you know, building out the first phases of a very large master plan community that his only metric, right, Erin, was to withstand the direct hit of a Category 3 hurricane, which unfortunately, but to some degree, fortunately, Hurricane Ian comes into the west side of Florida and the eye goes right over Babcock Ranch. A few trees, a few tiles. They are an exemplar. Now, there's some empirical evidence and some data that needs to be wrapped around some of it because the forecasting, right? But that was a little bit higher expense. Here's the sad truth. The insurance industry is somewhat backed out of Florida, all right? The FAIR plan is going through another re-up, meaning the state, last resort. And to some degree, Babcock Ranch hasn't truly been rewarded for doing the right thing.
Right.
Okay.
Right. Yep.
You have Howard Hughes Development Corp right here in our own backyard that decided to build out detention retention 1.5 to 1.75 larger than the base requirement was. And as a result, the Harris County Flood Control District became their partner because they could prove that what they did on Bridgeland was going to reduce potential flooding downstream, right? We've got a few of these. I think what you're encouraging and incentivizing, what you're encouraging is how do we incentivize, not these one-offs.
Correct. Like how like a bigger at scale, but also from a lending perspective, I think there's opportunity there. To your point, Babcock Ranch was not a super affordable place, right? But how can we leverage the existing real estate finance framework to perhaps allow these to become more affordable via Fannie Mae, Freddie Mac, right? They have credits right now for manufactured homes built to certain credits. Why can't I have resiliency credits that
Correct.
lowers interest rates, that helps affordability, things like that? Expansion of the green MIP program with FHA, like, because
Right.
I think you also need to put affordability into that, not just the resiliency.
And that goes also, and I'm going to open it up. I'm going to call out some folks that have joined us to give their thoughts and some questions into this because we're kind of in our last 15 minutes, Erin. But on average, it would appear that the cost per door per se for a multifamily, whether it's multifamily apartment, right, that the average national per door for insurance has gone from 600 to 14 to 1600. You can't pass that cost along to the person that's going to occupy that unit, right? So we really have what you've defined is truly a regional and national housing affordability issue.
Absolutely.
And it's only worsened. Frankly, I think it is creating, basically, we've got to choose as a nation whether we're going to do something about it or we're going to sink further into this gap, right?
Yes. Yes.
Um, I want to call on a couple of folks. David Marstead, are you still with us?
I am, Richard. Interesting
David,
conversation.
yeah, you've listened in on this, and coming from your role, both as an insurance commissioner in FEMA, in and out of the private sector, are we asking, are Erin and I asking the right questions? And I'm not asking you to confirm that. I'm asking really harshly, are we asking the right questions? Are we missing something? What do you sense taking away from what you've heard in your world we need to be thinking about more and what the actions may be?
No, I think you're definitely asking the right questions and in the right space. But I mean, what you're really talking about and what is the hard nut to crack from my perspective is the underappreciation of the cat risk associated with the natural disasters and the behavioral science piece of why people can't come to grips with what really is right in front of us right now when it comes to the increasing frequency and severity nationally of the handful of cat risks and what the costs are associated with that. And one of those behavioral is that we want somebody else to either fix it, handle it, or pay for it. And so what is the step that needs to be taken to it's a societal issue and situation. And so how can we better align what people's actions need to be in the results that we're hoping to see. And the costs associated with this are not they're growing,
Right.
and they're not accounted for. And whether it's a national program or a state program, there's a tendency by the policymakers, decision makers, to want to not have transparency associated with the real costs of the program.
So let me in my own way repeat back a little bit, David, of what I'm hearing and how I'm interpreting it. The country has really been built on risk transfer. And the reality is, unfortunately, over time, risk transfer takes away some form of accountability and ownership of what I can do to mitigate my own risk, rather than saying, hey, David, I'm going to build wherever I want to build, how I want to build, why I want to build, because I know you, David, will insure me. That model seems to be broken, right? So this shared ownership of risk is kind of what I'm sensing, David, we as a nation, and where it plays out for mortgages, becomes something that we've got to once and for all address. Am I saying that correctly, David?
Yeah. For sure.
All right. So then the question, I think, really comes back to something, David, we're working on, and Erin, back to looking at mortgages and multiple stakeholders. David's longtime friend, Benjamin Franklin, created not just the first fire engine, the first fire department, but actually created the first community mutual insurance company called Philadelphia, which still exists. But David, whether that's the right solution or not, it really is coming back to the idea that risk transfer needs to be moving into a higher level of resilience, higher level of pre-disaster. Is that where you think what Erin's talking about from the mortgage side, what we're talking about, is that someplace and somehow that we should lean into this?
Yeah, I mean, the situation is that we have to understand what the risk is, and then identify that, and then identify what actions can be taken to minimize the risk to the extent that it's economic to do so.
Right.
And then it's at that point that you transfer the balance of that risk to the insurance company. That understanding the risk and doing something about it. Some insurance companies are doing more in that space, in that, if you haven't done X, we're not going to consider you. And, there needs to be more of that. But again, it has to be across the industry. If there's only 3 companies that do that, I'm going to find the 4th that isn't going to make you do that.
Right.
And so that's why a lot of these things that we're talking about have to be, systemic to the high, all the folks, all the players, all the partners.
That's the other operative word, right? The other operative word is this needs to be a system, a connected network system that isn't placing the burden nor the obligation on only one part of the system, right? It really needs to be a system. Howard Kuntz with Cotality, formerly known as CoreLogic. Howard, what's your thoughts and thinking on some of this that you've heard so far?
Yeah, I just wanted to reiterate on things that were just said. So again, insurance is a risk transfer, right?
Right.
And and we said, somebody else, people want somebody else to pay for it and take care of it for themselves. The problem right now is at some point, and we were seeing this in Florida, and they've managed to stabilize it a little bit, but insurance premiums were going out of control, and they were becoming unaffordable. I mean, an insurance company can charge you actuarially correct rate for the risk that's there, but if people can't afford it, the insurance industry is unsustainable. So
Right.
as we continue to see not only the increase in potential increases in climate risk, but also as the reconstruction values of homes continue to rise at a rate greater than just regular inflation. We've seen premiums growing at a point where again, if they would continue this trajectory in some states, the insurance could be non-sustainable. So my point here is that it really does highlight the impact of the need for mitigation and resilience, and for consumers to take some actions to maintain, take some of that risk away. But and so the why groups like this are really important in that on their own they may not do it, and so there's a lot going on right now. I know with a couple different organizations, but it really comes down to about the sustainability of insurance if nothing is done.
Right. Let me play off, Howard, something you shared with me and then some, additional insight that we've gotten. So let's take a look at LA County, okay? In this whole massive challenge of rebuilding 20,000 homes in light of a 40,000 home deficit even before the fires, right? So what we've been told, and I'm telling you, cannot completely yet verify, but let's say the average home and land in LA County in the three areas where the major fires were was $725,000. All right. To rebuild now and to rebuild at a higher value of resilience is now coming up at 1.2, $1.3 million. That's not even throwing in, Howard, the issues of are the materials available, right? It's just the full replacement cost. Okay. So I think I think we kind of all know what the world looks like right now. I think, Erin, in our last few minutes, my sense is, and I'm going to put this up as nothing more than a straw man, something that we've been trying to look at. I'm not telling you this is perfect, but Erin, I think if as a straw man or whatever other, you know, concept that we can really bring the parties together around, including the incredible work that the Insurance Institute for Business and Home Safety are doing with their fortified homes, fortified roofs, now wildfire. But they're not alone. There's a lot of folks doing, like you brought to the table, some manufacturing, housing, and new kind of concepts. Erin, one more time, where do you want to be 6 months to a year from now? And can some form of a straw man type of concept come together that can then go be tested and scaled, that bring these pieces together, because it's ultimately going to have to be place-based? Erin, does that make sense?
Yeah, it does. So I'll give my best response and hopefully it will make sense. So, 6 months from now, I think that there's a couple things I would like to see. One is I truly would like to see some significant movement on leveraging the opportunity zones for
Yep.
our prototype community. But even on a smaller scale, I think that there are even smaller bites of things that can be done in terms of educating consumers and
Yep.
making sure that they're making smarter decisions when they're purchasing homes. Even, I mean, even something as education at the time of purchasing their home to understand what they should be looking for from a more resilient home or a home where they're not going to have where they're more insurable. But also something I'm working on right now is making progress from a lending perspective in terms of lending programs to where how can we create and promote affordable lending based products that will incent consumers to purchase or retrofit homes to more resilient standards. Because at the end of the day, affordability can be on an individual basis, and it's great to build communities, and I really want to focus on that, but I also want to focus on the individual consumer. And so in 6 months, I really hope to be driving more affordable lending products that help incent consumers to build and rehab.
So something we have not talked about, and I want to put a pin in exactly what you just said. Again, I'm throwing this out because it's just one thing that you and I think strongly agree on. We know the issues. We know what the challenges look like going forward. We kind of know who all of the different players, so to speak, that need to be at the table. We've got to take the table out of the room and move into these locations and start building.
Correct.
But you know
Correct.
what? We haven't, Erin, talked about, and I'll leave this as kind of our next opportunity, amongst this group, you and others. We haven't talked about the importance of philanthropy, who is telling us national, regional philanthropy, which means corporate philanthropy foundations and what we call donor advised funds, high net worth, right? There is a reason why they want to lean into this, all right? Because they see what the impacts are, for their communities, places that they care about, but also the increasing gap between those who can afford and those who can't. The other part to it is the employers. If I can't get my low to moderate income employees back at my plant or facility, I can get my facility and operations back up, but if my workforce can't return because they're
Right.
sitting in, now we've got a multiplier of partners and strategic, folks in this. And again, like you said, it can't be just the federal government, can't
No.
just be the government, can't just be the insurance or mortgage. So I do want to say that one thing we want to commit to work with you, Erin, and others is how do we capture this other source of investment by giving them the empirical data and the narrative of how this ultimately impacts
Mhm.
their bottom lines and what they care about emotionally and from a societal. All right.
Yeah. Well, we just have to be able to get in those rooms, right? I mean, the rooms where those people are is where we need to be, and we need to be having this conversation over and over and over.
Why did the theme from Hamilton of being in the room just start playing in the back of my head?
I have
Okay.
never seen Hamilton, so I have no idea.
Okay. Well, I'm gonna send you the link. So, Erin, this has been hopefully beneficial to what you're trying to do, what we're all trying
Thank
to
you.
do collectively. Y'all have got a major Texas Mortgage Bankers, has, and then from what I understand, the room's maxed out, but y'all are hosting a very, very important discussion about housing and affordability and bringing some of these players together. So my sense is your paper, the initial roundtable a couple of months ago, this conversation, these are not just one-offs. Erin, I want to thank you for kind of being that person who's beating the drum. And we're committed to bringing whatever we can, to the table in a way that ultimately, says people like you who are champions, we just need to find ways to start moving this into practice.
Yes. Well, thank you very much. I really appreciate the opportunity to meet you guys, to speak to you. If this is, Richard has my contact information. If you would like my paper, I'd love to send it to you. And just thank you. I'm happy to talk about this topic. It's so important, and I'm not going to stop.
Well, we need to go do it, right? We need to really move it into
Yes.
several places. And I really appreciate all who participated in what we call the live studio audience. And, Erin, as I said, we'll get the recording, share it out broadly, because I do think this hopefully will be an additional catalyst for those next steps. So thank you all for joining us today. It's been great. Erin, thank you for your leadership, both
Thank you
here
so
in
much.
Texas and nationally.
Appreciate it so much. Thank you.
Everybody have a great weekend, and thank you so much for your time.
Bye, guys.